All right, everybody, welcome back to the More Doors podcast. We are super excited today for our guest. Today is episode 23, the big 2-3. Wow. Man, I wish it was 23 again.
Yeah, my body recovered a lot faster from stuff when I was 23. I could work out like 3 times a day, eat whatever I want.
You still do that?
Yeah.
Oh, my.
I was also pretty dumb when I was 23, though.
That's not true. All right, everybody, episode 23, More Doors podcast. We have a special guest today, Carl Whitaker, Senior Director of Analytics at RealPage. We are going to come back and talk to him right after this. All right, everybody, we are back at the More Doors podcast, episode 23. We've got Carl Whitaker in the house. We are going to get a Texas multifamily market update from Carl in a second. For those of you that don't know Carl, he is an absolute analytics guru. Go follow him on LinkedIn. I'm not even going to wait till the end of the show to say that. When he speaks, people listen in this industry, and everyone who's passionate about the industry needs to go listen to him. So we're going to talk to him in just a second. But before we do, I want to say thank you to our show sponsors. Number one, Deep Blue Capital. Go check us out at deepbluere.com. If you want to see what the projects that we're up to, you want to sign up for our Crackerjack newsletter produced by the one and only Brian Force every Monday. Yeah, with a little bit of collab from our team. You just want to listen to the show, do what you got to do. Go over to deepbluere.com, check us out, subscribe, and we'll keep you in touch with all kinds of great information and potentially some things that we got working in the hopper.
Yes, we do.
Also, go check out Tor Studios, TORE studios.com. The one and only Jesse Showalter. Absolutely put together a great podcast, great guy, and go check him out if you're looking to get your message out there into the world of podcasts.
Oh.
What's up, B-Money?
Well, I think we've made it very clear that we no longer need Nick for this show.
Totally.
Because he's been gone. This is our second podcast of the day.
I think Nick has always kind of treated this as voluntary, by the way.
It's fair enough. He won't even hear that because he doesn't listen to the show.
That's fine. That's fine. Even if he's here, he's probably doing something else.
Exactly.
All right.
Without an intro, you did an intro. You did great.
Thank you. I'm going to tell my mom about that. I'm going to send her the episode and say, Mom, they finally let me do the intro. I'm sending this to Mama Booch. I'm telling you right now.
I love it.
Next Wednesday, she's getting blown up. I'm going to make her listen to it. All right. Without any further ado, I am excited. Carl Whitaker has taken time out of his day to come to give us a Texas multifamily market update. I'm actually really, really impressed too, because we've said publicly, Jesse's got the best beard ever. And wait till you check out Carl's flowing locks.
Yep.
I mean, the guy is, he's not only is he smart, but I mean, you got to check out this guy's hair. It's fantastic. So without any further ado, Carl, welcome to the show.
Thanks, guys. Y'all are far too kind. I've always joked that I've got a face for radio and a voice for newspaper, so I appreciate that. I appreciate that introduction there.
That's a good one.
Carl, before we jump into your market update here, which we're super excited about, why don't you tell everybody a little bit about you and what you do for RealPage?
Yeah, I'll try to keep it pretty short and sweet, but as mentioned earlier, my name is Carl Whitaker, Director of Research and Analysis. I lead up our team of market analysts and economists under our chief economist, Mr. Jay Parsons, another great LinkedIn follow for y'all that are interested in keeping up with the industry. And a lot of what our team does is focusing on market trends, how the economy is impacting supply, how the economy is impacting demand for that matter. And we'll talk about that here in a little bit. Myself, I get brought into a lot of these conversations where we just present what's happening in these local markets, how some of the national trends are affecting the local performance readings. But as you know, just with 150 plus markets that we keep up with nationally, it can be tough for one person to do that. So we definitely rely on the team to come up with a lot of these talking points for the metro level numbers.
Wow. Whew. Okay. So I want to super dive into that. I'm always fascinated with people that just, whatever industry it is, have really cool jobs. And I think that being just leading the entire team of analysts, I just want to know, like, what does your day-to-day look like? All of that. But first, I want to know, North Texas t-shirt. Are you a UNT guy?
Yeah, so I got my undergrad, my master's from North Texas. How about yourself?
I got my undergrad. I am not a master, but yes, a fellow UNT Eagle. So awesome, good to know. That's cool.
Yeah, I like it. It's good running into other Eagles out there.
100%, man, 100%. So before we dive in, and I do want to get really deep on we got this is the first slide deck we've ever done on the show, which is going to be amazing. Give us the 30-second ideology. Like, what is Carl's approach every day to the markets and just figuring out what the hell is going on and what will be going on in the future? If you got to distill it down into this is how we make the music, what does that look like?
Yeah, you mentioned there earlier, it's funny. I find myself super fortunate to do something that I really do genuinely love doing for a career. And it's basically analyzing data and coming up with those bite-sized takeaways that folks that aren't living, working, breathing in the data day to day. So what we generally do is we look at a lot of these trends, and there's so many data points. I mean, hundreds of metrics across hundreds of markets, and you can see how quickly that data set grows. So really what we do is we look and say, okay, if we've got an hour of an audience's time, such as today, or maybe, we've got 500 words that we need to cover that really talk about what's happening in this market, how do you get that message across in a succinct way, but also while delivering enough intel there that somebody's able to say, okay, I feel like I understand a little bit more about that market, much like the way that we would read, say Bloomberg to keep up with the stock market. We're probably not working in that day to day, but you read Bloomberg to kind of stay abreast of those trends. Yeah. So I'd say that's really the kind of the 101 of what we all do here.
I love that. I mean, that's a perfect explanation. You take a lot of different data and distill it down into bite-sized chunks so dum-dums like Matt and I can actually make something of it and try to make some decisions.
Thank you for putting us both in that category. It's usually just me. It's usually just me.
I just felt like I was going to be on an island and bring you with me.
You're the knitter. All right, Carl. Why don't we jump in? So, usually we try and focus on multifamily across the nation, but today we're gonna be a little selfish, and we're gonna talk about the home field advantage of Texas. So, wait till you see all this stuff. I mean, it's fantastic. I don't know if you've seen Carl before, Brian, but I mean, he not only do they put fantastic slides together, but Carl actually, he knows the stuff.
He knows the stuff.
It's amazing.
All right, let's dive in. So Jesse's got the deck here. Let him know when he needs to switch. But Carl, take it away for us. Kind of talk us through what we got here on the deck.
Yeah, for sure. And actually, before I begin, just to add one thing here, you'll see the source there. A lot of this data is coming from our market analytics platform. I'll extend that Bloomberg analogy from earlier where, if you have a Bloomberg terminal that has access to all this data, this is how we're lifting that out there. So that's kind of why I led with that Bloomberg comment earlier, where a lot of what we're doing is just presenting these data points and, again, to help folks stay abreast of the trends. Now, before we get into the Texas numbers here, one small, I guess not an asterisk, but one thing I wanted to preface the data points with. I think the national discussion right now is that we do see that performance is slowing, rent growth has come down, occupancy is getting back closer to, say, a 20-year average. We're far past the peak that we saw the same time last year. But the real takeaway here is that today's performance slowdown doesn't appear to be a demand-driven phenomenon. Instead, it appears to be a supply-driven phenomenon. Okay. And if you go back to your, think back to your Econ 101 textbook, whenever you have even consistent demand in an environment where supply is increasing, and nationally we see that more units are under construction than any period in the past 40 years. When that happens, you see pricing adjust. So really, again, the takeaway both nationally and for many of these Texas markets will be that supply is the key force creating downwards pressure on performance. Right. And that's probably going to remain a trend through 2024.
So that'll remain a trend through 2024, and maybe this is already kind of in the the deck. So I don't want to jump ahead, but when you have supply driven markets, you have that kind of supply balance, but demand is still strong. What I had also heard is the amount of new permits being pulled is way down, way down.
Yes,
and so that supply issue might be something that drives rent prices or rent rates, potentially rent growth right back up 24, 36, 48, 60 months from now. Is that something you guys kind of have on your horizon as well?
Yeah, and I think that's really the takeaway that I'll talk about in some of these individual markets too, is that when you look at basically the difference between supply and demand, supply is always cyclical. You see ups, you see downs. Things like the interest rate environment can create downwards pressure on supply. Cheaper access to money and liquidity that can increase supply, which we saw up until this point, essentially. But when you take a step back and look at demand is more often than not structural. Sure, you have little peaks and valleys. You saw demands during the Great Recession. That was a cyclical point of demand. But when you look at a 10, 15, even say a 5-year hold period for apartments, that's where you start to look at the structural tailwinds. Population growth, job growth, wage growth. These things are long-term economic trends. They aren't driven by, a 5 to 10 year monetary cycle the same way that supply would be. So I think the demand outlook remains really good for the long haul.
Sure.
We're just at a point of time where supply is going to outpace demand, at least for the next 12, maybe 18 months.
Sure. I appreciate that explanation.
Yeah.
I love it when we're able to break it down like that.
Absolutely.
Yeah. So what do we got here on the first slide? Let's dive in.
All right. So looking at the Texas markets here, and happy to share some thoughts on the smaller markets if helpful. We're just kind of keeping it to the big Texas 4 right now. Not sure how familiar the audience is with the idea of the Texas Triangle. Is that something that y'all come across?
I don't know that we've ever talked about it on the show before. So give us kind of the 5-second breakdown.
Yeah, so the Texas Triangle is the Interstate 35, Interstate 45, Interstate 10 corridor that basically connects the 4 or 5 markets that you see here. I guess technically 4, but really DFW is one contiguous market. Right. In that Texas Triangle, something like 80 to 85% of the entire state of Texas lives in that corridor, which when you look at the entire state's footprint, it's actually pretty small of a corridor. Yeah. But, this is where most of the demand is going to be. So we'll focus mainly on that, but I guess long-winded way of saying it, if we'd like to get outside of that corridor, then happy to do so. I actually personally live outside that corridor in East Texas. So,
okay.
Cool. You can get some perspective there. But nevertheless, looking at the slide here at hand, this is looking at the percent of submarkets in the state that are seeing rents fall on a year-over-year basis. Now, this is looking just at what we call same store. So this isn't taking into account new properties delivering. But if you look at existing assets, you'll notice that here in third quarter 2023, almost 60% of submarkets in the state are seeing rents fall annually. Yeah. Now, when you look at that on a market by market basis, this is going to be the first of many times I say this today. There's a pretty clear relationship here between areas that are delivering more supply are seeing rents backtrack faster. Yep. Conversely, areas that are seeing less supply are seeing less downwards pressure. And Austin kind of comes up as the bogeyman here, where 100% of submarkets in Austin are seeing rent cuts as of third quarter 2023. Some of this in Austin, and we'll talk about individual markets here in a second, but some of this points to just the inherent volatility that market has shown historically. Sure. But the key takeaway is really that Austin is delivering essentially more units than anywhere else in the country when you look at a relative inventory growth rate. Yep. Now, you compare that to DFW, you can see about 50% of DFW submarkets are cutting rents. But on a percentage basis, even though DFW leads the country in volume of supply, the percent is smaller because you're applying it to a much bigger basis. And, DFW doesn't have quite as much economic volatility happening right now. Migration trends have been strong into DFW for many years now. Now, the one that stands out to me here that's maybe the surprise is Houston. That's going to be that dark blue column. Okay. If you go back to third quarter 2020, and even pre-COVID, even in third quarter 2019, Houston was the one spot in Texas where it wasn't uncommon to see rent cuts. Today, that number has actually come down. It's still about a third of the market is seeing rents fall. But again, the takeaway here is that relative to Houston's quote unquote normal level, that market's actually not delivering as much supply as it was in the 2010 cycle. So a clear relationship when you start breaking out these submarkets that supply is indeed the biggest downwards force.
Sure. And do you attribute, and I mean, this is kind of for everybody there, right? So obviously one of the reasons, or well, I say one of the reasons, one of the considerations when going into the Houston market, insurance volatility across the board has been a challenge. We're trying to make deals pencil.
Yeah.
Houston, I think, especially when you're talking about Texas markets, because it's close to the coast, and you're talking about, you know, not only your normal insurance volatility, but hurricane, flood, all of that type of stuff.
Yep.
Do you believe that lack of new supply coming, or that smaller amount of new supply coming on, which means that fewer assets have had to, or fewer areas have had rent cuts, is that attributed to the volatility in insurance, taxes, everything else that leads to deals not quite being able to pencil, and maybe developers going like, I'm going to stay out of here from a new construction standpoint?
What do you think about that, Carl?
Yeah, it's a good question. The expense side of the equation is something that's going to be a huge focus point in 2024 as income growth slows due to supply. How much does expense growth increase? And, you know, there's some things that payroll, maintenance, operations, some of those expenses are going to start to slow down, or I should say the pace of growth among those expenses is going to slow down. We're already seeing that inflation on aggregate is starting to come down. It may not feel like it, but the numbers do show that prices aren't increasing as fast for many things. However, insurance is kind of that one thing that that is still seeing a lot of increase. And I think Houston's one of those markets that, that's another consideration in terms of just overall assessing whether or not that deal pencils out from a development or acquisitions perspective, for that matter. Florida gets brought up a lot. I think Florida is kind of like the case in point example, but here in Texas, I would say Houston's your biggest consideration on the insurance side. Now, the one thing that I will add too, and this is going to be ubiquitous across all Texas markets, another consideration is how fast do taxes increase? And as you and both and our audience know, insurance and taxes are kind of the one thing that we're most at mercy at when it comes to even our personal expenses. So I think that's going to be a big consideration, but maybe to your point, more so a consideration in Houston.
What are your thoughts on, let's just get hyper political. No, let's not do that. We say, things that we're most at mercy at are taxes and insurance. And the reality is those are those couldn't be further apart as far as market forces go, in my opinion, because insurance still operates as a free market. If insurance gets high enough, somebody will come in and buy market share at a lower rate, right? So just the capitalistic forces determine that insurance can only get so high so fast because somebody will be able to do it for cheaper and undercut big margin. Taxes are different. There's no cheaper guy coming in and you're paying less property taxes. How realistically, in your opinion, let's take the Texas market, how long can this rate of property tax increase even continue before it legitimately throws the economy into a hyper downward spiral because operators can no longer afford their assets and I mean everything that comes along with that? I mean, how long could those increases go on?
Man, that's a really good question. And, honestly, I don't know that I have a strong opinion one way or the other, but I do think if I had to just venture a guess, I would say that when you start seeing a precipitable slowdown in either the number of people moving here due to tax burden or the number of businesses moving here due to tax burden, perhaps that could be something that helps push back on the pace of increase. But that's probably my best guess, to be honest.
I think especially that's true in Texas, where lower taxes has kind of been our tagline.
Yeah, I mean, I first of all, I came here from New York, right, and it was like lower taxes, but then there's the tollway, right? And I give back half my savings in tolls. I think property taxes. It's very interesting. So we acquired an asset earlier this year, and we were shopping around for insurance. And the replacement value that most of our insurers came back with was like $150 a square foot, which put our replacement cost at about $2 million higher than the purchase price, about 50%. And then we acquired the asset. We closed and we got our tax bill. And sure enough, the tax man wanted the same $150 a square foot, and they assessed us with a $2 million higher valuation than what we paid for this thing. So it's very interesting to see how those numbers were eerily similar, right?
It's almost like those guys know each other.
Yeah, it's almost like it. But I'm very interested to see how this tax reduction effort impacts the business over the next couple of years, right? Everything that we're underwriting right now is at 100% of the property value times the mills rate, because I think municipalities probably need to recoup some of the COVID money. And they're like, if you want to buy it, right, similar to single family housing, you're going to pay for it in multifamily. But hopefully these tax rates start to trickle down in 2025 and beyond.
100%.
Hopefully.
One thing I'll add to real quick on the conversation of taxes is that I think where Texas kind of becomes a safe haven, even with the increase that we've seen, is that in comparison to, say, California or New York, maybe some of these areas that historically garnered a lot of capital coming in, the Texas markets, at least I don't foresee, the Texas markets don't have this up and coming trend that we're seeing in those coastal markets of transfer tax. Now, transfer taxes may be embedded in some individual municipal levels, but statewide, places in, say, California, Los Angeles, for example, have implemented this transfer tax where upon selling a property, you end up owing an additional 4 or 5 percentage points on the original transfer tax that you would be paying. And in some instances, that makes a disposition of a property just not make sense anymore for investors. So I think that Texas will remain at least a safe haven in that regard. But in terms of just the actual property taxes, or in terms of the the insurance, and keep in mind, just because Texas's threat to, say, climate change isn't as great as, say, Florida, at some point that pool of capital in the insurance arena gets spread to the consumer regardless of where you're at. Maybe Columbus, Ohio doesn't see insurance go up as much as, say, Houston, but at some point those other folks do start to feel that, because that cost does get spread amongst a much larger pool than we see.
Yeah, that's a really good point. I had never really thought about that. I mean, it's all the same insurers. Eventually, it's going to make its way inland as far as the cost of the consumer.
Absolutely.
That makes perfect sense.
Carl, in your conversations, I know you talk to a lot of people. In your conversations, what is the overall sentiment about insurance from a continued price increase perspective, and like, A, where's the top, right? And B, is there a government legislation program? Is there any sort of lobbyism going on about taxes? About insurance? Because at some point, operators can't make money. They're going to start passing those costs on to the residents.
Yeah, I think that's going to be the thing to watch for. And again, I don't know that I have a strong opinion one way or the other on this, but I do think at some point it's going to need to be visited by some governing entities, just because I don't know that any of us realistically know where that top is, but there is at some point a finiteness and a ceiling that's going to run up against.
Yeah, got it. Makes sense. Okay. And so what do we got next, Jesse? Let's pull this up.
All right. So going back to the point that I made earlier, that today's performance slowdown isn't necessarily demand driven. And in fact, you can see places like Austin, which we just talked about as having more common rent cuts than anywhere else in the country, actually ranks second in the nation for absorption. So, it certainly doesn't seem that today's slowdown is driven by demand, but rather a supply-driven phenomenon. Phoenix, I know we're talking about Texas today, but Phoenix has kind of been that market everybody's pointed to of, the apartment market crash is here. We don't think that that's the case. We think that just the fact that Phoenix is delivering, more units than it has in 40, 50, maybe ever, actually, in terms of Phoenix development. But you've actually got pretty strong absorption. DFW 7,200 units. And you'll notice here that 3 of the 4 Texas markets rank in the top 10 for absorption nationally. So I think this is one of those tailwinds that you're going to see Texas markets continue to ride.
So Phoenix is an interesting example, because I don't know if you know any of the, have an idea off the top of your head. When you talk about historic rent increases since the beginning of, let's say, the pandemic, do you know where a market maybe like Phoenix falls as far as average rent in Q3 of 2023 to Q1 of 2020 before the pandemic? Are we still quite a bit higher?
Yeah, we're higher than what it would have been over, say, a normal 5 to 10 year period.
Right.
But as you point out, what we're seeing is that I was actually at a conference yesterday, and somebody mentioned this and said that the way the real estate returns work is you have to count the negative years in with the positive years.
Yes.
And I think that's what we're seeing is that some of these markets like Phoenix, sure, lease trade out or rent growth was up 20% at the peak. Now rents are falling by 5% year over year. But if you drew, say, a 3 to 4 year cumulative trend line, they're starting to get back closer to that trend. And this really goes back to the point, too, of just having reasonable underwriting expectations when acquiring properties. I don't think any of us, at least hopefully none of us, were underwriting 10% annualized growth in Phoenix for a 6-7 year hold period.
Right.
Now, that doesn't mean that today's pain isn't necessarily, certainly not an enjoyable market, but by that same token, if you look at that longer term trend, markets are kind of finding some re-equilibrium.
Yeah, and I mean that's one great advice for underwriters. Just don't think that any trend is going to continue forever. But also just kind of the sensationalist way that we kind of cover our industry in multifamily real estate, right? You can have, a lot of rent cuts, and Phoenix becomes the poster child of the multifamily housing collapse, where it's like it's legitimately just a reversion to the average, right? Like you're looking at the tail end of a rent growth phenomenon, and you're saying that this is the epic failure of multifamily in Phoenix. We're like, no, if you look at the historic average, you're pretty much right on pace with where rent growth would have been, maybe even still ahead of pace from pre-pandemic to now. We stand very close to the mirror and we think the world is falling apart, when really this is inevitable because wages are going to grow at the pace that wages grow at. People got to be able to afford units. And so if you get that high, your volatility, the tail whip, is going to be relatively volatile.
Yeah, but you just made a very good point. So something that both I think Carl and Jay have been talking about a lot lately is that income is growing at a higher clip than rent growth, right? Lately.
You told me that in a very snarky text message, and I believe you.
Did I?
Yeah.
Okay. I mean, I've been known to do those once in a while. Usually on Tuesdays, or other days that I did. Why? But that's why I think to reinforce Carl's point is, I think this blip, for lack of a better term, is a collision of taxes, insurance, interest rates, and incoming supply.
Yeah.
I think the market would have been a lot more resilient if only one or two of those had happened at any given point in time, rather than all four simultaneously.
Yes.
But that leads me to believe that, barring any sort of geopolitical crisis, right? And we know there's some terrible things going on in the world right now. I mean, I think that when this rebounds, it's going to be material.
Well, if you could pick your poison of all those different variables, you'd probably always pick high demand and solid wage growth.
Yeah, absolutely.
That is a recipe for resilience over time.
Right. As consumer sentiment improves, right, and the economy kind of runs its course on the soft landing, people are gonna start shopping around for housing the way they were.
Agreed 100%, man. What do we got next, Jesse?
All right. So this is looking at a slide that looks, this data point is annualized apartment starts. So we talked a little bit about supply earlier, but the best predictor of what's going to deliver tomorrow is what started construction today.
Sure.
And when you look at starts in third quarter 2023 across the state of Texas, you still had about 65,000 new units that got under construction. But if you go back over a 10-year period, that's pretty much what you would expect over a long-term average. And in fact, that number is going to come down more with interest rates still at a very high level. Mm-hmm. We see that the biggest downwards pressure for developers today is access to capital. And as access to capital remains very limited or limiting, we're going to see the starts number come down. But really, it's that year-over-year change number, I think, that matters the most. Starts today, in other words, apartment units that turned dirt over the last 90 days is down a total of 40% from where it was the same time last year.
Wow.
And sure, it's going to take some time for those units that are working through construction right now to lease up. But this right here tells me that by, call it late 2025, certainly by 2026, you're going to see a precipitable pullback in the actual number of units coming to market. So this does, again, appear to be one of those things that informs a market turnaround probably by late 25 and certainly by 26, where performance remains steady, or demand remains steady rather, and supply starts to ease.
Yeah. And I mean, this is obviously what you guys do every day, and this is part of your job. So when RealPage is publishing their rent growth forecasts and things like that, this is exactly what you're taking into consideration.
It's all baked in. Yeah.
When this is gonna when the amount of new units coming on is going to start to really dry up, and then you take in, population forecast, income, all that type of stuff. It is a fascinating thing that you guys do. And I love to be able to just kind of see it in visuals like that, because it helps guys like us make decisions.
Absolutely.
Very cool. All right, Jesse, what's next here?
And then here's just a quick breakdown of how those starts look by market. We won't go into great depth on all these, but pretty much anywhere in the state is down, call it 40 to 60% in terms of new units starting. Some of the small markets, Sherman, Denison, Corpus, Lubbock, they've gone up a little bit, but that's really just a small numbers problem. You start with such a small denominator that it's, it looks like a lot. It went up 200%, but it went up 200 units.
It went from 1 to 2
as well. So yeah, exactly. It went from 1 to 2. It increased 100%. That really, it's not really that relevant, but again, it's not like some markets are seeing a slowdown in terms of starts. This is what every market in the country looks like, just about. So I think that you're going to see 24 be the supply peak. 25 remains a pretty big year for construction, or for deliveries rather, and then 2026 is where the market starts to get back to a more palatable supply level.
Yeah. And, so I've seen Carl put out some really good information 6 or 7 months ago. I was able to watch about starts and new builds, specifically in like Frisco, McKinney, Allen, right? And I drive on 75 almost every day.
Do you drive, or you just sit there?
I try and drive. I sit there sometimes, and I fly the rest.
I had to take that to a coffee meeting yesterday, and I texted him like 45 minutes before the meeting. I was like, I'm already telling you I'm going to be 20 minutes late.
Nice. Yeah, no, I kind of got bit at the same time yesterday. But point is, right, like there's huge construction going on up there. There's new overpasses. There's HEB is just starting to land in the area after them being around for however long. Yeah. New Whole Foods, et cetera, et cetera. And since I've lived in McKinney, population has gone from 100 to 160,000 in 9 years, right? So we're all kind of freaked out about all this new incoming supply. And everywhere you look in McKinney, there's new builds, and they're getting built very, very quickly. Mm-hmm. But I think there's a lot of smart people behind those decisions saying there's a lot more people headed here. Yeah. Right. And if we get in now, even though the market's suppressed and capital is expensive, et cetera, does this pay off because of the schools and the taxes and the favorable business outlook, et cetera, et cetera? So it's kind of one of those things where you kind of buy real estate and wait. Don't wait to buy real estate, and let the rest of this play out, because there's some really smart people justifying huge investments in the area, because they're seeing the demographic and they're seeing the demand both now and in the future continue. I
agree 100%, man. How many stories have we? No, go ahead, Carl. Sorry.
One thing I'll just add in there real quick, and something that this idea that absorption follows supply. One of the reasons DFW has been allowed to grow so fast is because there's housing stock to absorb. And you compare that to places like New York or San Francisco, where historically they probably would have grown more, but there's just no inventory to be absorbed. 97.5% occupancy. You're lucky if you can find a few dozen vacant units. And of course, there's some more challenges there too. But this idea that the markets that are growing the fastest are delivering the most supply, well, that's because, again, people have a place to move to.
Yeah, the demand's there, across the board.
And I'm not the smartest guy on this call, and I know that, but Carl used New York and Jesse smiled. He knows. New York and San Francisco are both islands.
Yeah.
Right? There's only so far and wide you can go without needing to go up, right? Which means you got to buy something, knock it down, right? It's there's so much undeveloped land in Texas still that like I'm very bullish on let's welcome more people here to build more real estate.
Come on down.
Yeah, just go to deepbluere.com.
We'll hang out. What do we got next, Jesse?
All right, so we'll do a little bit of rapid fire on some of the markets here. Looking at Austin performance, we shared this earlier that, number one or number two in the country in terms of absorption, but we're seeing that rent growth isn't happening. And in fact, rents are falling on a year over year basis. Occupancy rate here in the market, 93%. From one perspective, if you go back over a long period, 93% isn't necessarily a poor reading for Austin. A lot of these Texas markets, because of the supply figures, have often been lower occupancy. Markets just kind of find an equilibrium in terms of their occupancy, and Austin's isn't far off 93%. Now, the jarring thing is that the metro has fallen 170 basis points over the past year. So you've seen that occupancy contract really quickly. I think my concern in the Austin market as we go into 2024 is if you look at that resident retention rate, about 49% of residents renewed their lease in Austin over the past 12 months. But if you look at September and even October data here more recently, that number is coming down further. And I think what you're seeing in the Austin metro is pretty simple. So much inventory is delivering that residents have more available options to choose from. On top of that, if you look at how that renewal rent growth line there, that blue line has grown relative to the green one, new lease rent growth, the takeaway is that at some properties, it became more expensive to renew your lease than to go get a new lease elsewhere.
Exactly.
And when those rent rolls invert, that incentivizes a resident, that there's no reason that they're going to renew. They're going to go find a new lease. And I think the last consideration with Austin, and this is the harder part to truly forecast, but turnover costs, those haven't gone down over the past year. In fact, it's more expensive than ever to lose a resident. But on top of that, you have the soft cost of losing a renter. And while 2 years ago, maybe that unit was filled in 14 to 21 days, now you're looking at 30, 35, 40, 45 days to fill a unit. And that's ultimately lost revenue in a period where more supply is going to deliver. So I think Austin's one of these markets that this next slide actually shows our forecast. The following slide shows our forecast. I think Austin's going to be one of these markets that it's challenged in 2024 before the long-term demand starts to win by 25, 26, 27.
Yeah. I can understand, man. That is a really, really interesting take. I think it's really interesting. And I think I've experienced this firsthand, right? When it becomes more expensive to renew than to move, that's kind of like almost, if you consider it on a market, almost like an inverted yield curve, right?
Yeah.
So that's really, and how big of big of an event is that for a space like multifamily? When we have an inverted yield curve in treasuries, right? Like the whole world just goes, oh my God.
Right.
That's a pretty big indicator for the downward pressure on a particular market?
Yeah, market wide, it's a little bit harder to tell, but I think with a property level is where it ultimately matters. And we're all investing in properties, not markets per se.
That's true.
So I think the property level is where it becomes a bigger concern, and it takes a really good operations team to find a way to correct that in the course of one or two leasing cycles.
Yeah. And also kind of on a related note, I read a stat recently that in some markets, the difference in average rents between A class and B class has narrowed to the point where folks that were in B class, they may be able to jump up to A class now because there's so much incoming supply. I think it was like $84, $85 difference in some markets.
Yeah.
Like if I have a stable job, why wouldn't I make the jump for $84 or $100?
Yep.
Right. To a newer property with more amenities and just kind of the better feel.
It would be very interesting to see what the transience of B to A and A to B
would be
like.
very interesting.
And then
we might know a guy that can help us.
I
with
know.
Well, funny you say it, because that last slide that we skipped over, the one before the forecast, that actually shows what that B to A rent gap looks like in Austin. And you can see that Austin, relative to the nation overall, is quite a bit smaller. So a quick summary of the graph here. This looks at 2020's new builds relative to properties that delivered in each of the previous decades. And the gap between a brand new property in Austin and one that delivered in the 2000s, it's only 10% difference. So if you're an operator and you offer a 2-week concession, that takes that down to 5%. And that causes some of that upwards filtering. But in Dallas, it's less of a headwind because that gap is a little bit bigger.
Look at you calling it out.
I pay attention.
That was amazing.
That's work.
Very cool, man. Okay, so now I'm like so invested in where the story goes. Let's keep going here, Jesse.
So San Antonio, I won't spend as much time on the San Antonio market. Still a little bit off the beaten path, off the radar for most investors and developers. Now, having said that, you can see that almost $2 billion worth of properties still traded here over the past 12 months. It's certainly not totally off folks' radar. 18 or 17,000 rather units under construction, a lot of inventory delivering here. I think San Antonio, both historically and today, is just a little bit more sensitive to supply. You don't have quite as much of that corporate style, HQ style employment driver as say DFW or Austin, and certainly not Houston to that degree as well. Now in San Antonio, occupancy's got to a point where I think there's maybe a little bit more concern heading into 2024, just 91.5% of units filled. On one hand, San Antonio has historically been the nation's lowest occupancy market, at least among major metros. So it's not like this is uncharted water for San Antonio, but still at market average of 91.5%. You've got some properties that are dipping below 89% occupancy here. So I think there's some concerns in some local pockets of the market heading into 2024. Now, the next two graphics on San Antonio show how that premium of B to A rents is quite a bit larger. So I think here Class B is a little bit more let's call it insulated against some of the supply pressure. In other words, that A inventory that's delivering today, or that new inventory delivering today, is inherently competing with a Class A market rather than the Class B market. So maybe there's a little bit of insulation in B and C units here locally. But our takeaway on the forecast for San Antonio, this next slide, is going to show you that the recovery, we think that will happen, but we don't think San Antonio is going to rank in that top quartile of performers in the coming few years. And I'll kind of counter the San Antonio take over the short term with maybe a long-term silver lining. I think San Antonio, if you're looking at, say, a 7 to 10 year hold on a property, what may be worth considering in San Antonio is that as the Austin market has become more expensive and more expensive, San Antonio's relative affordability has become more attractive. So much like we saw with South Florida in the 2010s, as Miami became prohibitive for a lot of movement into the market, a lot of that population growth started to target Tampa, Orlando, more affordable areas. So I think San Antonio, over a long period, may capture more of a share of inbound migration than it did historically, just because it's more affordable, and especially in a work from anywhere environment where you not necessarily tethered to an office as much as you were.
Yeah, that's a really good take. That makes a lot of sense.
Yeah, I think you get a couple of big companies that decide to drop an HQ in San Antonio, and all of a sudden it becomes the West Austin.
West Austin, still hill country. Yeah, 100%, man. That's very cool. What's next, Jesse?
I think that's a good takeaway there. So DFW, we technically split out Dallas and Fort Worth within our data, so I'll focus more on Dallas here. There's a lot of synergies between Dallas and Fort Worth, of course. Region-wide, incredible demand. And I think that's going to remain the case for the long haul. DFW on aggregate, I don't have the exact number, but for the past 15 years has added something like 110,000 new residents per year. So, just incredible growth. I don't see that necessarily slowing down. You have seen performance slow down here a little bit, again, due to the supply pressure that the market is seeing. But recall those retention rates we saw on the previous slides. Dallas has a retention rate of about 52% currently. So you're not seeing as much turnover in the market. You're not seeing that loss to lease come down. But I think the biggest wow stat here is $7.2 billion worth of properties traded hands in Dallas over the past 12 months.
Wow.
At the peak during the 2021 transaction boom, this was north of, I don't have the exact number, but I think this is down 65, 70% from the peak level.
Wow.
And Dallas is, I think there's a very real argument that Dallas has kind of become the 1A Sunbelt market that competes with the gateway markets in terms of both domestic and international investment appetite and outlook. And while we're in this short-term period of supply running ahead of demand, I think you just have to bet with Dallas demand over the long haul. And, the market's going to continue to grow.
Man, the window is open.
Carl said so.
Yeah, no, that's a hell of a take. I mean, it really is. I mean, like, it goes back to the entire premise and theme that we're talking about. Demand is strong. That's what's going to drive resilient markets long term. So if you get a pocket where supply is not down, but it will be down in 18 to 24, 36 months or whatever, when new stuff coming online starts to dissipate, and you have a 65% reduction in volume trading hands, bet on the long-term demand of that market and you'll probably be all right.
Yeah, agreed. Yeah. Again, I'm not the smartest guy on this call, but to me, it seems like that makes sense.
Carl makes it easy to sound smart, though, because he gives us bite-sized chunks.
All right. I really like this slide, too. This is looking at 3-year cumulative demand. Y'all were talking earlier about that 3-year rent growth, and it's important to look at longer horizons. And DFW from September 2023 to March 2020, 70,000 more occupied units in the market today than 3 years ago. 70,000 additional occupied units, not existing.
Did you say 3 years?
3 years, yeah, March 20 to September 23.
That's
70,000?
That's bananas.
70,000 additional occupied units. And, you can see Houston's number 2 there. And to Houston's credit, 50,000, 55,000 additional is a strong number. But, Dallas is just head and shoulders above some of these other markets in terms of demand. And our forecast on this next slide will reflect that, where you can see that, this brief period here where rents are slowing down, demand's going to win in the long run. Now, the one caveat I would add here in Dallas is that we see some pretty big separation between submarkets. Matt, you quoted Frisco and McKinney earlier. Rents are falling faster there because more supply is delivering. Conversely, in some of the areas of the market like Mesquite, Garland, Southeast Dallas, you're still seeing rents grow by 3, 4, 5% on a year-over-year basis. Yep. And that's probably the case in point of where supply is delivering, rents are facing more pressure, downwards pressure. Where no supply is delivering, this rising tide lifts all ships of the local economy, still generating jobs, still generating wage growth. And you can see where demand over a long haul is probably going to win out against supply.
Yeah. I love this illustration and the breakdown. This is fantastic.
Carl, I'm sorry, just go back one, Jesse, for a second. Mm-hmm. So the numbers are a little small for me and my eyes are getting terrible. Mm-hmm. What would that peak? Oh, so that's first quarter 2022 is the peak?
Yep. First quarter.
Okay.
Yeah, that makes sense. Wow. Take us to Fort Worth.
All right. So I'll go through Fort Worth here real quickly. The one thing I would point out on the Fort Worth slide relative to the Dallas slide, that average household income is quite a bit lower in Fort Worth. And for folks that are familiar with DFW, Fort Worth just tends to be a little bit more blue collar, tends to be a more affordable side of the DFW Metroplex. And you see that in the data. The reason I bring that up is that Fort Worth is also more sensitive to new construction. That doesn't necessarily say that Fort Worth can't support new construction. It's just that when supply delivers, Class A fundamentals in particular tend to slow down a little bit quicker than what you see in Dallas. And you'll notice on the next slide, because of that, we have Fort Worth positioned to underperform relative to Dallas. Now, we're talking markets here. That doesn't mean each individual submarket or neighborhood will see the same trend. But I think it's fair to assume that Fort Worth underperforms in the short term due to that sensitivity of supply. But still, to use the expression again, rising tide lifts all ships. Fort Worth's economy benefits just as much as Dallas's does from the regional boost, and demand should be pretty strong here for the long haul.
Wow. Let's bet on DFW.
Yeah.
That's a big takeaway.
So, Carl, when you think about Fort Worth, right? Let me ask you this. Let me ask it differently. What is Fort Worth from a geographic perspective for the purposes of this data? So does it go all the way east to, like 360 between Grand Prairie and Arlington? And how far west, north, south? Can you give us an idea there?
Yeah, it goes a little bit further east than that. 163 or 183 is basically the easternmost boundary. Basically, DFW Airport is where it splits. It goes all the way up to Justin, so not quite to Denton County, but pretty close. West out to Weatherford and Parker County, and then the far south edge is a little bit further south than Burleson, basically Johnson County.
Got it. Cool. Thank you. Yeah, I mean, that much geographic area. There's a ton of different markets inside, right? I mean, you go from as dense as you can possibly get in where like 30 and 121 meet, right? And then down south you're talking about you get acreage on the manufactured homes, right? So I think it's a very interesting MSA to dive into. We don't have to do it now, but like I think I think you have to be very, very specific on where you're looking there.
Yeah, you do. I would say that the original thesis really shows itself in that illustration there, though, because we're talking about Fort Worth being an MSA, but talking about supply kind of driving the market. There's so much room there to add supply. Demand is already there. If you were to just have a common sense investing thesis, bet on the places where demand is high and you have room for more supply.
Yep. Agreed.
Yep, absolutely. All right. So last but not least, we got Houston here. Talked a little bit about Houston not seeing as much supply. It's not saying that there's no supply. There's still a lot of inventory underway. But Houston, for the first time in a couple of years, is seeing less relative supply deliver than the national average. In other words, other markets are delivering more relative to their existing base than Houston is. And I think this is good for Houston. I think Houston's one of these markets that's been out over its skis a couple times in terms of supply. It's easy to go find land there. It's cheap to go find land there. If you can't find it in the energy corridor, just go out to Sugar Land. And that's why you see that sprawl happen, especially in Houston. I think it's probably the biggest geographic footprint for an MSA in the country. Maybe Atlanta gets that same shout too. But, the Houston fundamentals here, you're seeing occupancy hasn't fallen as sharply, down 60 basis points on a year-over-year basis. I think that Houston, on a relatively speaking basis, is maybe in the best position relative to the other 4 Texas markets or the other 3 Texas markets that we've seen in some time. The thing that's not captured on this particular slide, though, and I think what comes into play more so in Houston than other Texas markets, single-family housing is still relatively affordable in Houston. And in fact, John Burns Real Estate Consulting puts out some really great research on this. And I don't know if it's still true with where interest rates are today, but I believe last year, Houston was one of like 4 markets in the country where renting and owning were basically at a break-even point in terms of just overall cost. Most other markets, it's like 20%, 30% more expensive to own than rent today. But Houston, a little bit different in that regard. The other thing in Houston, the energy sector, Houston has diversified the economy a little bit, but the energy sector, oil and gas prices, that's still the tail that wags the economic dog in Houston. And I'd have a little bit of concerns on that over the long haul. The next slide, though, does show that Houston's forecast does a little bit better. All right, I'm sorry, there's that construction rate relative to the national average. But this next slide on the forecast shows that Houston gets a real short-term bump here in 23 and 24. I think that's related to expected improvement in the energy sector, but it ultimately ends up forfeiting some of that because it's inherently a more volatile market. There's opportunity here. There's opportunity in every market. I think you just have to be more familiar with the local nuance. In Houston, it's kind of its own beast relative to the other markets across the country.
Wow, makes perfect sense.
Yeah,
makes perfect sense.
And Elon is setting up shop in Austin to give the folks in Houston a run for their money.
Oh, that's right.
I'm reading the new Elon Musk bio by Walter Isaacson.
Oh, yeah?
Very, very interesting.
Pretty good. What's it called?
I think it's called Elon Musk.
Oh, I always,
Hence-
yeah. No, I just sometimes they come up with cool names, you know. Man, oh, I know that we want to be respectful of your time, Carl. This has been, and we might just need to do a part 2.
We're gonna have to.
We're gonna have to, because I know we have so much more to dive into.
Yeah, I mean, look, I think there's so much here, right? We're just kind of skimming the surface at the MSA level. You start to get into some markets and stuff, and and we can go down a rabbit hole. But this was fantastic.
I really, really would love to.
Carl, I'm sorry, but
please.
from your perspective, right? Give our listeners, if you had, clearly there's the demand piece of this, right? The supply piece, the demand piece, but like, what's your overall outlook about things? 2023 has been a tough year for a lot of people. And would you say that there's hope? Is there a light at the end of the tunnel here?
Yeah, I would say 24 looks a lot like 23. The one unknown is, again, how fast do expenses grow? I think by 25, you see some markets start to rebalance. The sum, meaning I don't think Austin does by that point, just because you've got so much inventory delivering there. 26, things start to look really good, basically everywhere, now Austin included. So I'd say 23 and 24 kind of draw a flat line. 25, you start to see a little bit of improvement. By 26, you're looking at the traditional 2, 3, 4% rent growth that you would expect.
So it's not quite time for Jerome Powell to climb across that or aboard that aircraft carrier with the mission accomplished banner, but we're getting close. Maybe one more year.
I'm telling you, cuts are going to start tumbling in summer of next year.
Mm-hmm.
And just in time for all those variable rate caps to expire, and a bunch of those guys are going to end up being okay after all.
Yeah,
and just in time for the election too.
So
by the way, but we're not political, so we don't talk about that stuff here.
Carl, we got to have you back, man. This was not only was this a blast, it was super informative. I love chatting with you. And I cannot wait to dive even deeper when we have you back next time, for real, man. I appreciate you coming on and appreciate the time.
Yeah, I appreciate the opportunity and happy to keep the conversation going.
Thank you, Carl. Appreciate your time, brother.
All right, thanks, y'all.
Episode 23 in the books. We'll chat with Carl again soon, hopefully. And thanks for listening, guys. Check out deepbluere.com and tourstudios.com, and we will catch you next week.